everyone, welcome back. And here is Ali Talabi. I hope you are doing well. This is module 20 and lesson 3 from this module. So we talk about risk management. In the previous lesson, we talked about forwards and futures. And now I'm going to talk about one of the most interesting topic in the world of risk management, options. So we'll talk about some options basics today, and I will talk about the differences between the stock options and the stocks. So we'll use some terminology so you will understand some related terms and concepts to the options. And we'll talk about the intrinsic value and the time value, and also we'll talk about the in the money, at the money, out of the money, and what are the differences between those terms. And at the end of this lesson, I will talk about the options, payoffs, and profits. And if you're interested in the options more, in the next lesson, we'll talk about some options strategy which you can make under different scenarios. And later, we'll talk about options pricing as well. And I will tell you how to find the value or the price of the option. So let's start our session. So when we talk about options, there is a major difference between options with some other financial assets. So as we learned previously, options are classified as a type of derivatives, which means they derive or they get their value from underlying assets, similar to futures, similar to forwards. Options are considered as a derivative security. Now, when we talk about the option, either we talk about the call option or the put option. First of all, remember, it doesn't matter it's a put or call, you are talking about the right. So that's the right to buy or right to sell. So what do we mean when we say right? It means it's not a commitment. So you can use that. That's why we call it the option. So you can use the right or you can ignore it. So when you're talking about the call option, you are talking about the right to buy the underlying asset as a specified price at the time in the future. So when we're referring about buying the underlying asset, it is called call option. If you're talking about the right to sell the underlying asset, you're talking about the put option. And now this underlying asset might be a stock, might be a commodity, might be another financial asset. So the idea here is you have variety of choices for the underlying asset. So there are a few notes here you have to focus. First of all, in this module, we are mainly focusing on the stocks option, and for sure, again, there are many other forms of options. Next, remember, you're talking about a time in the future. You're talking about the specific price at the time in the future. So it doesn't mean you have to wait to see what is your buying price or selling price. You set the price now. This is very similar to what we had before for the futures and forwards. You are setting the price now, so you know how much you are going to pay if you're buying or how much you are going to receive if you are selling. And we call that price exercise or a strike price. So the price which you are going to buy or sell, that underlying asset is called exercise or a strike price. So we'll talk more about these related concepts later. So again, we're talking about a sort of contract when we refer to options. So we talk about taking a long position or a short position. The buyer, the person who is buying the option, he's taking the long position. The person who's selling the option is taking the short position. And sometimes the seller of the option is also called the writer of the option. So you have to distinguish between the call option, put option, and the buyer or seller the option. You might still be the seller of the call option. The call option is the right to buy, but you might be the seller of the call option. So you might write the call option. So we'll have 4 possible scenarios in this case. So for the call option, you can buy the call option or you can sell the call option. For the put option, you might buy the put option or you might sell the put option. So remember, you can take any of these 4 roles when it comes to the world of options. So I mentioned that when it comes to options, you have the right, so you don't have to exercise, you don't have to use the right. However, it doesn't mean the options are free. You have to pay for the options, and the options you are the money you are paying for the option is called option price or option premium, and which for sure is the price or premium is lower than the underlying asset, but still you have to pay for it. Usually we're talking about the stock options. As I mentioned, mainly here in this session, we'll talk about the stock options. And remember, for the listed stock options, we are talking about the right to buy or sell 100 shares of a stock. So that's how the stocks options are kind of set. So when you're talking about the right to buy or sell, mainly you're talking about buying or selling 100 shares of a specific company. And we already talked about the expiry date. So there is an expiry date for the option, 2 months or 3 months from now. However, when you can exercise your option, if the option gives you the right just to exercise your right at a specific time, for example, exactly 2 months from now, 3 months from now, on May 15, for example, or July 20th. So it is called European style option. European style here means the exercise date is set. It's just one day, so you cannot exercise earlier. However, when you're talking about the American style option, you can exercise or you can use your option anytime before the expiry date. So for example, if it's May 15th, you can exercise on May 1st, you can exercise on April 20th, anytime before that, whenever you feel that it's beneficial for you. So be careful, the options you are buying, it's European style or American style. So here's an example from Microsoft. So I took this screenshot from the Yahoo Finance. So if you choose a specific company like MSFD, Microsoft, you can go and look at the options tab as you see on the top, and it's showing the different prices or the different premiums for different expiry date. For example, the first line here is showing the expiry date of March 19th, and you see that the exercise or strike price is 65, and all of these are call options. If you scroll down, you will see there are some put options as well in the Yahoo Finance webpage. So what does it mean? It means you have the right to buy Microsoft at $65. Maybe you say, Ali, that's a great opportunity because, for example, the current price is over $230, $235. If you look at the top here, it's showing the stock price. So it's much lower than the current stock price. But remember, you have to pay premium. As the strike price or exercise price is getting lower than the stock price, you see the premium is going up. So if you look at the premium is around $178. So you have to pay that high premium, which means technically you cannot make lots of money on that. And again, the expiry date is sometime in the future. It's very close to the stock price listed. This information are taken on actually March 12th. So you see that just you are a few days away from the expiry date of the first call option. If you scroll down, I don't have the full screen here. If you scroll down, you will see as you are getting a longer term expiry date, the exercise price is going actually up, and on the other hand, the premium is going down. So maybe say, Ali, why should I buy stock options when I have ability to buy stocks? And for sure, there are several reasons. Usually we use options to hedge ourselves, to protect ourselves. For example, if you expect that a specific stock is going down, what you are going to do, you can buy the put option. You can buy the put option for a specific stock which you expect the price is going down, because put option gives you the right to sell the stock at a specific price. Let's say it's $100, so you can sell it at $100 no matter what's happening in the market. Here is look at the example and see how actually the stock option is different than the stocks and what type of risk or return it can provide to you. So suppose Microsoft is selling for $200 per share now, so it's clear the stock price is $200. And the call option with the exercise or the strike price of the same amount, $200, let's assume is $5 per share. Just to make it simple, I'm just using the same exercise price. For sure, we can go with different prices here. So it means you have to pay for each share, you have to pay $5. And we just learned that we're talking about a bundle of 100 shares. So you have to pay $500 premium or price to buy the rights of buying 100 shares of Microsoft. So if you invest on 100 shares, how much money you need? For sure, if you buy just the shares, you need to pay $20,000, which is $200 times 100 shares, clear. However, how much money you need to buy just the call option? Just $500. You see, the initial investment is much lower when it comes to buying the call option, much lower than just buying the stock itself. So let's assume 2 months from now, that's the expiry date. So that's a deadline. So we go with 3 different scenarios. 2 months from now, let's assume the Microsoft stock price goes to 210, 200, or 119. So I'm going to show you what will happen under these 3 different scenarios. How much money you make if you own just the stock, how much money you will make if you just own the options. So let's look at the table. So when you look at this table, you see that the left column, actually the left part is showing just buying the 100 shares of Microsoft. The right column is showing the buying one call option, which gives you the right to buy 100 shares of Microsoft. So in the first case, let's assume the price is going up to $210. So if you just own the shares, you can make 5%. So it's going up from $20,000 to $21,000. So $1,000, that's your return, the dollar return, which means percentage-wise, you are making 5%. Now, let's look at the call option, see what's happening in this case. So in this case, actually, you are making $500. Why this is happening? Because you have the right to buy at $200. You can buy at $200. You can sell it right away at $210. So for each share, you are making actually $10. However, you have to pay $5 per share for the premium. So for each share, the net profits or the net profit in this case is $5. And $5 times 100 shares, it becomes 500. So you can see your return percentage-wise is 100%. You invested $500, you are making extra $500. So on the top of the money you paid, you are making another $500, which is 100% return, which is amazing. Now, in the second case, let's assume that the stock price doesn't change. It's around the same $200, and for sure, the stock return will become 0. So you neither gain nor lose, just 0%. But what about the call option? So it doesn't make sense to exercise your option because you can actually buy at the same at the same price, which was $200, as you see, and the exercise price is 200, the market price is 200, so it doesn't make sense to use your call option. So what does it mean? It means you will lose as much as the option price of premium, which was $5 times 100, which is $500. So the whole money you invested on the option is gone. So you're losing 100%. Now, no matter what, as long as you won't exercise your option, the maximum you will lose is the same amount which you paid for the option premium, which is $500. So even if the price goes lower, for example, $109, for the call option, you're losing 100%. What about the stock? For this stock, you see that in this case, you're losing $1,000 if the price goes down to $109, which means you are losing 5%. Your return is 5% negative, so you're losing 5%. Now, if you compare both options, what's happening here? You see that is much less volatile if you are investing on a stock itself. When it comes to the option, you see the volatility is much higher, so it gives you kind of leverage when you are buying the call option. Dollar-wise, you see that the call option is giving you lower gain or loss. However, we are mainly concerned about the percentage, and you see the percentage-wise, the gain and loss with call option is much higher than the just underlying asset, which is the a stock. So this is showing how volatile might be the investment on the stock options. So you're exposed to some degree more risk in case of making more money or losing more money. But I will show you later how you can use actually options, or how you can combine different strategies, different options or stocks, just to come up with the minimum possible risk. So let's talk about another important topic, which is related to the option, which is called intrinsic and time value. So we mentioned that the options, either call or put, you have to pay premium for that. The option premium, or the price, is based on two major factors. These are intrinsic value and the time value. What is the intrinsic value? What's the time value? The intrinsic value, that's the value of the option if you exercise your option right away. So, and for sure, this value is always positive, and the least or the minimum amount of intrinsic value is always 0. So for the call option, intrinsic value is the maximum of 0, or a stock price minus exercise price. So S is a stock price, and K is exercise price, or the strike price. And the put option, you can see, is maximum of 0, or K minus S. So you can calculate, or you can find the intrinsic value of either call or put option using this equation as we mentioned here. Now, this is interesting to see that for sure over time the intrinsic value is changing. So for the call option, if you look at the graph, it's showing the value for the intrinsic value for the call option. So as the stock price, so the horizontal axis is showing actually the stock price in the market. As the stock price is going up, you can see the intrinsic value of the call option is going up, because you have the right to buy at a lower price, so you can make more money. That's why that blue line here is showing higher profit for higher stock prices. That's the intrinsic value. What about the time value? The time value is the value of the amount of time which is remaining until expiry date. As you are further away from the expiry date, you have more options, or you have more time to exercise your option. And this is mainly relevant for the longer term period. So if you're talking about the longer term period, so you have more chance to exercise your option. So as you're getting closer or approaching to the expiry date, the time value is getting close to 0. So for example, if today is the expiry date, the time value should be 0. And the last point here is you can see the time value is the highest when the stock price in the market is same as your exercise price. So in our case, for example, if let's assume $100 is your exercise price, that's the maximum value for the time value of the option. Now, for sure, you heard about some terminology related to the options, which is called in the money, out of the money, at the money. What does it mean? So it's all about the actual intrinsic value of the option. So we already talked about the intrinsic value. So the question here is, if you exercise your option right away, will you get some money? Will you lose money? If you are making money, so that's the situation that you are in the money. So again, in the money, it shows that the option would yield to a positive payoff if you exercise it right away. So, and what is the payoff? Payoff is different than the profit. In the payoff, you don't include the option price. You just include the stock price in the market and the exercise price of your option. So be careful with the terminology, payoff, not the profit. So you are in the money again if you exercise right away, and you can make money on the option. And for sure, for the call option, the stock price should be greater than the exercise price. However, for the put option, it should be opposite. The stock price should be greater than the stock price, because you have the right to sell. So you want to make sure that the market, the stock goes down in a way that it is even lower than the exercise price. What is the at the money? So if the chance is very low, but it might happen if the exercise price is exact same as the stock price in the market. You are at the money, so you are actually breaking even. So in this case, there is no gain or loss. Out of the money, if you exercise right away and you lose the money, that's the case that you're out of the money, which means for the call option, the stock price should be less than exercise price, and for the put option, the stock price should be greater than exercise price to put you in the out of the money position. So I mentioned that you have to distinguish between payoffs and the profits. Payoff doesn't include the option price, but profit, it includes the option premium or the price. So here I'm showing you the 4 possible situations can happen for the put option, call option, and you can take different positions. What are these positions? So you might buy the call option, you might actually write or sell the call option. You might buy the put option, or you might write the put option. So different scenarios will lead to different actually payoff and profits. The 2 graphs on the bottom are showing the payoff. The 2 on the top are showing you the profit. For example, if you look at the one on the top, the left one, it's showing that as the buyer of the call option, you will lose money as the stock price is lower. If the stock price is less than the exercise price, you will lose money. How much? As much as the option price or premium, in this case is $10. You are losing $10. As the price is going up, you see that you are catching up, you are making more money. Let's assume, for example, the price is $80. It means that you are on the positive side and you are making money when it comes to call option. Now, if you are taking the writer position, so if you're writing a call option, so you hope that the stock price goes down, because in this case, the option holder doesn't exercise the option, and you will receive the premium, which in this case is $10. However, if the stock price in the market goes up, the option holder will exercise its option, which means that you have to buy at the higher price in the market and sell to the option holder at the lower price, so you will lose money. So what is your maximum loss here? As a writer of the call option, your maximum loss is technically unlimited. So you might lose lots of money in this case, because the price technically can go up as much as possible, as high as possible. Well, that's it for this lesson. So we talk about options, put option, call options, and now you know some terminologies related to this topic. In the next lesson, I will talk about some strategies which you can use to get best of the options. And also we'll talk about an important notion of put call parity, and you will see that how we can link the put options and call options. Till then, have a wonderful day. Talk to you soon, and here is Ali Talibi.